I guess I'll go ahead and get started and we'll let people trickle in. And I might have to add people to the presentation, so work with me.
I don't think enough people have voted that, but
I know.
It's okay.
Well, yeah.
And feel free to get lunch. Okay, I'm gonna go ahead and get started. I'm Caroline Chandler. I'm with Banker Exchange. Our office is actually in Greenville, South Carolina. However, we can do 1031s across the U.S. I do business development, and I cover most of North Carolina and the upstate of South Carolina into the Midlands and into Rock Hill. We have another business development officer who's in Charleston in the Low Country, and then actually my boss sits in Colorado. So we're kind of all spread out a little bit, but we can do 1031s everywhere. We try to avoid California, but we can do them in California.
why is that?
California, they want 5 different extra forms. They actually take back some of their state taxes right at the start. You have to keep all this documentation in case. It's just a headache. It is. But we, Banker Exchange is a qualified intermediary, so we help real estate investors and owners defer capital gains taxes. I've been with the company for about going on 8 years now, but the company, John Boyd is the founder. He started about 31 years ago, which was actually before the regulations were even fully released. So he is an expert in this topic, and I've had the awesome ability to train under him. So here's the agenda for today. I'll do a brief but thorough overview of 1031 exchanges, talk about the benefits, what they look like at Banker Exchange, and leave time for questions. But feel free to interrupt me through the presentation with any kind of questions. I want to make this as casual as possible. So I'll start with the overview. So this is Banker Exchange's favorite quote, words to live by. I'll read it. No gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment, if such real property is exchanged solely for real property of like kind held either for productive use in a trade or business or for investment. Truly music to our ears, right? But why am I reading this to you? Well, this is the Internal Revenue Code section 1031, and it gives us the requirements for the deferral exchange. These are the 4 requirements for the deferral exchange, and all 4 of these must be met to fully defer capital gains taxes. I will say fully defer capital gains taxes a lot because that is their main goal, but there's also a way to partial defer capital gains taxes. So jumping through each one of these, I'll start with qualified use. If you remember our little favorite section from the Internal Revenue Code, it also gives us the definition for qualified use. So qualified use means any real property held for productive use in a trade or business or for investment. So now you're probably like, what kind of properties would qualify? Types of properties that would qualify would be raw land, commercial properties, single or multifamily rentals, DSTs, easements, ground leases, all qualify. Types of properties that don't qualify would be primary residence, vacation homes, second homes, timeshares, stock bonds, and notes. I know a lot of you do primary residence, so you're probably like, what? But vacation rentals do qualify. So the mountain rental, the lake rental, the beach rental, single family rental do qualify. There are several misconceptions through the presentation. The first one is if my relinquished property is land, then my replacement property must be land in order to meet like kind requirement. So like kind, for those who don't know, refers to nature and character of the property, not grade or quality. So as long as you're meeting that qualified use, you're golden. So doesn't necessarily mean you have to go from land to land. You can, but it gives you the opportunity to go from land to single family or commercial to single family, or however you want to mix up, as long as they are both qualified use. So used for investment, business, or trade. So there's a few other things that we have to make sure we check off when establishing qualified use. First is the duration of ownership. How long has the property been held? Well, there's actually no set guidelines in the IRS that says the exact period that has to be held. but the safe period is 2 years or 2 tax periods, which could technically 1 year. There's a lot of exceptions to a lot of these rules. Exception here would be an unsolicited offer. So say your client just bought a single family rental, they're in there painting it, fixing it up to put a tenant in it, and 3 days in, someone comes, knocks on the door and says, I want to buy this property. They could do another 1031 exchange because their intention was to hold it for investment and put a renter in it. Another one you'll see is for sale signs or versus available signs, which gets around the holding. If you buy a property and then put a for sale sign in it tomorrow, your intention is that you're wanting to resell it and not hold it for investment. So the way around that is available. Available could be for rent, could be for lease, could be for sale, but no one knows what that means. So it's kind of, now you drive around, every property has a available sign on it because it just gets you around that holding it for 2 years. And they want to see the 2 years is from the closing of the sale. And then when you go to buy your next property, that you're going to hold that for 2 years. Again, 2 is loose terms. Nature of use, basically that you're going to use it for the investment. That you are going to use it for rental, you're going to limit your personal use it for business. Raw land, you don't actually have to have any business on it. It can just be raw land. They can include that as investment. Basically just not using it for personal. Record keeping is just keeping good records and documentation just in case you were ever to be audited. We've actually never been audited for a 1031 exchange. The client has been audited for something else and then they saw there was a 1031 exchange. So just keeping good records that your intention for the property was to hold it for investment. I've mentioned the word intent a lot of times. Something as subjective as intent is very hard to prove, but is very easy to disprove. And of course, that burden of proof is on the taxpayer. So if you're dotting your I's, crossing your T's, you're going to be good to go. We have clients walking in the gray and they're good to go. So I always say it's between you, your CPA and the Lord and how you feel like what you could do around it. The next is the value requirements. So the value requirements obviously deal with the money of both the property being sold and the property being purchased. I'm going to go through each of these real quick, defining. So relinquished property is the property being sold and the replacement property is the property being purchased. I use those terms just to make sure we all know what they mean. So the equal or greater is when you're looking at the replacement property, what you're going to go buy, it needs to be equal or greater value of the sales price to what you just sold. So if the client sells for $500,000, the replacement property needs to be at least $500,000 to fully defer capital gains taxes. Next is the reinvestment of proceeds. So this is there's 2 options. So first is using all of your funds from the sale into the next property. You can also do a partial, and that's only using a portion of the funds from the sale into the next property. The portion not reinvested is subject to capital gains taxes. So the full is the goal, but a lot of times people want to do a partial. Yes?
Sorry, you may have said this. Can one property sell multiple properties?
Yes. Yeah, so you could sell 1 property, you could buy 50 properties. You would still just need to put those funds. A misconception here is that you only have to reinvest the cash. You actually have to be in the same position with your debt as well. So you pay off a loan of $50,000, you need to have equal or greater value of $50,000 on your next property. If your client doesn't want to get a new loan, they could just pay capital gains taxes on the loan portion. So any debt reduction is seen as a benefit, you're going to be paying taxes. Say your client has $50,000 under their bed, new cash, they can bring that to offset the debt as well. You cannot get a higher loan to get cash back. Any money that touches the taxpayer's hands, they're paying taxes on it. Another term that you will hear through a 1031 exchange is boot. Boot is any additional value received during the exchange that isn't like-kind property. So that could be cash out, that could be personal property, that could be the debt reduction. Any boot received is going to be taxable. So here's an example. So let's say Josh sells a property for $1 million and pays off a mortgage of $300,000. To fully defer capital gains taxes, he would need to buy a property at $1 million and have a new mortgage of $300,000. Say he didn't want to get that new mortgage, he just wanted to use his cash. He would be paying taxes on the $300,000. Does that make sense? Any questions? Next is the mandated timelines. If you've heard of a 1031 exchange, I'm sure you've heard that very strict timelines. And that I will say in a 1031 exchange, that's the fastest clock ever ran. Day 0 is the day the relinquished property was sold. Funds transferred, deed transferred, day 0. From day 0, the taxpayer has 45 days to identify properties. These are calendar days, not business days, so includes weekends and holidays. From day 45, they have an additional 135 days to purchase something they've identified, so that the whole process is 180 days. I'm going to come back to this one. So on the 45 day, an identification form is due. There are 3 rules. IRS is like, there's rules for everything. So there's 3 rules for this identification form. It is due by midnight of the 45th day. And so and this is where basically you're writing properties. I think I have a picture of her. Here she is. Basically a blank paper where you are writing properties on these lines. They have to be legit properties and they have to be very specific. It can't just say the corner of Main and Stone. There's 4 corners. It has to be 123 Main Street, apartment A, building 3, where if the IRS were to Google it, they are finding your property and there's no question it's that property. If they're identifying land, it can't just say a portion of 100 acres. Which portion? I always say print out a map, show me which portion you're buying so that there's no question this is what you're buying. But so they're writing out these properties. They don't have to be under contract. We suggest that they're kind of in the negotiation or that you've tried, but they don't have to be actually under contract. And so they're writing, I'll skip back to this. Filling out the form, we're going to use the example of the client sold for $1 million. Filling out the form, the first rule they could use is the 3 property rule. This is if they list 3 properties, value does not matter. They can list one for $2 million, one for $50,000, one for $500,000. Doesn't matter. And they would choose, they could buy all those properties, they could buy one of the properties, they could buy none of the properties. But that's after day 45, they could only buy from that list. The next rule is the 200% rule. So this is if they want to list 4 or more properties. So let's say they're going to write 6 properties down. They're writing their 6 properties down. Their fair market values do matter. So you have to total up all their fair market values, and that total cannot exceed 200% of what they sold for. So in our little example, it would be $2 million. So if they're listing one for $5 million, they're over that 200% rule, and we would suggest them to go back to the 3 property rule. 200% basically is giving them options, but not a ton of options. If they're looking for properties in the million range, they're going to be over it fast. But if they're wanting to buy a ton of properties that are 50,000, then they can list a ton, right? The next rule is the 95% rule, which is a crazy rule, but it's out there. If you do exceed the 200% rule, so you've identified all these properties, they equal 10 million. You must buy 95% of the things that are listed, which is crazy because you don't have the 1031 cash for that. It works in certain situations, like an investor that we know that's going to be buying way up in properties are in value, and they're using all this outside cash. But that's really the only time it works. And a lot of times, if people don't check with us when that 200% rule and they just turn their ID in and they're over it, we can't go back and change it after day 45. So, I mean, we monitor the 45 day like crazy. We send reminders like we're blowing up your inbox. A day, about a week out, we're getting on our broom and finding you to make sure that you have you know you're turning this in, especially around holidays. It gets really crazy. So I'm gonna jump back to this misconception. I can get my money back at any time if I change my mind about completing a 1031 exchange. So you cannot. The earliest you could get your money back would be day 45 with no ID form. So you get to day 45 and you're like, I can't find anything. I don't want to buy anything. We can return your funds on day 46. You would be paying capital gains taxes. If you turn in an identification form, and let's say you get to day 60 and you're like, I don't want to do this anymore. Never mind. I want my money. Unfortunately, we'd have to hold your funds till day 181 when your exchange expires. The toughest conversation ever to have with a client because they want that money, right then. And these are the IRS rules. Even if everything on their identification form has been bought or doesn't work or fell through, we still have to hold your funds till day 181. The IRS deems everything always for sale. You can't buy it, but you could go buy it, so it's just a IRS rule there. Say your client does buy, say you get to day 70, they bought one property, but didn't use all of their funds. And they said they were only buying one property, only identified one property. We can return the funds the day after they buy that property because they said they were only buying one property. It's marked on the form. It's not like they verbally said that to us. Any questions with the properties? So there are no extensions for the 1031 exchanges, and it's actually the only place in the IRS code that does not allow extensions for weekends and holidays. The exception to this rule is if there's a federal declared disaster in the area and the IRS agrees. I would say North Carolina and South Carolina are more of the luckier states. Normally they're just give it to the whole state versus sometimes in Georgia and Florida, only certain counties get the extension. Helene, pretty much everyone received the extension. But the extensions are huge. So they move your 45th and 180th day out so this one is till May 1st. And the hurricane happened in August, right? September? There was another one before that. So the August one also received the Helene extension. So that is huge because we rarely see that. Also, it was because the QI is in the affected area, the client in Texas could still receive the extension, even though he has no properties in South Carolina or North Carolina, because the QI is there. So that is huge. But otherwise, your 45th day is due on the day that it is. Doesn't matter if it's your wedding day, your birthday, Easter, Christmas, it is due on that day. So I've had several calls on holidays. 4th of July one, I was on a lake and I'm getting a call. I feel like this is my client. I answer and he's like, I think my ID's due today. And I'm like, you can't hear me. I can't really hear him. And I'm like, send me a text right now of your ID. Didn't really go through because I was in the middle of the lake. And I'm like, I've been telling you for 45 days now that this was due today. So planning around holidays is kind of crazy. So then the next requirement is the administrative requirements. As I mentioned, Banker Exchange is a qualified intermediary, and we play the third-party role. We only wear the hat of the QI. That's something very important because the QI cannot have any relationship to the transaction. So that cuts out your banker, your realtor, your attorney, your CPA, all of the people that you might trust in the transaction, they cannot be a QI. So that is why we are that third party. A lot of other QIs could also be attorneys or banks, but you want to make sure that taxpayer is not banking with them or isn't doing anything personal with business-wise with that attorney or that bank. It could get really in the gray and mess up the 1031 exchange. You also must have a QI to do a 1031 exchange. You cannot just sell a piece of property and buy a piece of property. You need the QI to connect the two transactions. You also want to make sure the taxpayer enters into an exchange agreement with the QI. Basically, it just says the taxpayer cannot access the funds during the exchange. Same taxpayer rules. We'll talk about that here in a second. financing and funds is a huge thing. So banker exchange price itself, we have segregated bank accounts. We open up a new bank account every single time for every single client, no matter if it's their fifth exchange or their first exchange. We have great banking relationships, and they're pretty good at getting a number to us. But you want to make sure if your clients are using other QIs that they are not commingling funds. If you have a transaction, you need your funds. Well, Josh needs his funds, and he can't get them because we've sent them out to everyone else because they were commingled and not sure whose funds are whose. So that's huge. Things go downhill really fast when QIs commingle their funds. So it's something to keep in mind. So here's the same taxpayer rule. The replacement property doesn't have to be purchased the same way the relinquished property was titled. Well, it does. So the taxpayer that sells has to be the taxpayer that buys. So if it's Johnny selling in his under his social, Johnny under his social must buy. Johnny cannot add wife because that's two socials. It has to be him, and then down the road he can add wife. But the way he sells must be the way he buys. If he wanted to open up a single member LLC that files through his taxes, that works because he's still filing through his social. Through his social. The same with the LLC. If an LLC sells, say it has 3 members, that same LLC must be the buyer on the replacement property. There is a way to drop out people from LLCs. You can say the LLC had 3 members. 1 member wanted to not do a 1031 exchange, and 2 did. The LLC can continue. Joe could drop out, get his money, and pay taxes. It gets a little bit more complicated when it's a 2-member LLC and 1 person wants to drop out, because then that LLC is now a single member LLC. He can either add someone, or they can all drop out as tenant in common and figure out what they want to do. If you have any clients that might think they might do that, call immediately because it needs planning and it needs to happen before it's even under contract. But like I said, there's normally a way to do anything your client might want to do. You could either drop them at the front or drop them at the back. Another misconception is that relinquished property has to be sold before the replacement property can be purchased. So now you're probably thinking, well, everything you said, that would make sense. But the IRS actually released a safe harbor for the reverse exchange. So you can actually buy prior to selling. And if you're thinking there's multiple types of 1031s, there is. So there's the simultaneous exchange, and that is basically swapping properties. I want your property, you want mine, we're swapping. There's the deferred exchange, which I've talked about, is the selling and the buying. The construction exchange is selling, buying, and then wanting to use your 1031 funds to make improvements. And then there's the reverse exchange, like I just mentioned, buying before selling. You can also do a reverse construction, buying, making improvements, and then selling. Both the reverse and construction cost more. They happen all the time. They're not this new thing that just popped out. People are like, that doesn't seem real, but it works. Happy to answer any questions on that too. This presentation doesn't really cover that, but yeah.
Could you give an example timeline of the reverse?
Same timeline. So it's your buying is day 0. You still have 45 days to figure out what you're going to sell. And then you have the additional 135, what you're going to sell. Once you sell, it basically turns into a forward exchange. And we assign, I didn't talk about this part, but we assign the 100% membership interest in that LLC back to the client to show a sell to buy, because the IRS wants to see a sell to buy. So the loophole around that is our sister company opens up an LLC, buys that property, taxpayer is funding it, and then we assign that back. That was a lot, but
Restart the clock.
So they each have their own clocks. So the reverse is still 45 to 180, but when you sell your property, you have, again, the 45. It's basically us just giving you back the property. Does that make sense? Okay.
So it is or is not as simple as you buy the property and you basically have 180 days to close on the property.
You're selling. Mm-hmm. Yes. So what are the benefits of a 1031 exchange? There's several benefits of a 1031 exchange. Some of my favorite estate planning benefits. It's a great estate planning tool. We like to say swap to drop. So the taxpayer continuously does 1031 exchanges over and over again. They sell and they buy, they sell and they buy. The taxpayer drops and their heirs get a step up in basis. So that's fully paying no taxes. We say deferring capital gains taxes because if you were to sell the property or sell and then buy, and then if you were to go sell that property, you're actually paying capital gains taxes from the one before. So that's why if you continuously do them over and over again, they're swiped away. We have so many clients that are like, oh, I got this as a gift right before they died. I'm like, no, like you could have saved so much tax, like you'd have paid none. The gifting seems like a great thing at the time, but it's actually they could have just paid no taxes. I love the one where it gives you the opportunity to diversify your properties. So you're owning raw land and now you want to make some income. You can go buy residential rental, multifamily, and now you're making some income. It also gives you the opportunity to but to relocate your property. So with y'all being more of the residential side, clients moving from Texas to North Carolina, you're helping them move their residential, find a new primary home. But always ask if they need to move or if they want to move their rental properties or any investment properties with them, because they can move them over the state borders. I find a lot of clients want their investment properties near to where their home is. So something always to keep in mind if you're more just primary residence. But obviously the main goal is deferring capital gains taxes. And without that main goal, none of the other ones would be able to happen. And here's just a little reminder of what those taxes look like. So if you had the opportunity to defer these, it can be anywhere from 15 to 28%, depending on the client's tax bracket. I'm sure they would rather defer them than pay them. Yes.
Are y'all anticipating any changes to this with community administration?
We're always on the chopping block, but nothing's ever actually happened. We have great lobbyists in our 1031 organization, and right now they're saying not near any time soon. But always the question. So the lobbyists they do a great job saying why people need 1031 exchanges. Also, like I said, we're not wiping we're not wiping them away. We're just deferring them for a little. Majority of people are paying taxes on their properties. So this is our Baker Exchange team. We are a smaller team, and we pride ourselves on that because we do give excellent customer service. When you call us, you're not getting 5 different buttons trying to find a person. You are assigned to a coordinator. You work with the coordinator the whole entire process. If you can tell, we have one male on our team. He is our boss. And then some are accounting, some are in-house counsel, coordinators, accounting. I said that, sorry, marketing. So a few recaps here is selecting the QI. You want to make sure they have the segregated funds and that they only play the hat of the QI, or there's no personal interaction to the party. Another one is, I guess, our fee. So our fee is $1,500, and that includes 3 closings. So a sale and 2 buys, 2 sales and 2 buys in that $1,500. Each additional closing after the third is $250 each. The reverse and constructions start at $5,000. Depending on how complex they are, they can go higher. Seller financing has been a bigger thing lately. We charge a fee for $500 for that if they bring it into the exchange. But just comes out on the closing statement. No check is written, just a closing cost, the attorney actually sending that to us or the title company. Let's see, what else? The process has anyone done a 1031 exchange in here? Yes, okay, a few. So the process is pretty easy, but when to call us? Soon as possible. We can do 1031s all the way up into the closing table, but if the sale has closed and the funds have gone to the taxpayer, it is too late. We've done a ton of closings or ton of 1031s at the closing table where they're like, oh, the attorney calls and says, we're in closing right now, can we do it? And we're like, yes. We can, but to drop everything else and to get this done. So that is possible, but before they're under contract, if you're talking to us, but really once they go under contract, I would call or tell your client to call their QI. Sometimes the QI is the last person called when we really need to be called ahead of time because we are sending instructions to the attorney of how the settlement statement needs to look. So basically at the closing of the sale, the funds get wired directly to us. We're holding them until they're about to purchase or their exchange frustrates. We wire those funds directly to the next attorney for the closing of the purchase, or if they buy nothing, we wire them back to the client. Pretty easy. Same with the reverse. Well, not actually. The reverse is complicated because the taxpayer is buying the property essentially. But that is the easy steps of how a 1031 works. Obviously, can get complicated really quick. But I would love to be a resource for you all. This was a lot of information and don't feel like you have to keep it all in. Just know that investment property, basically anything that's not your primary residence qualifies for 1031 exchange. Yeah.
What makes someone's got a property they live in the primary home, but they Airbnb the second structure on the property now. Would
it be on the same tax parcel? Probably.
Particular example I'm thinking of.
Yes. And they're just wanting to sell, or one's primary. So you would just on the settlement statement. So they're selling the whole thing, essentially.
Yeah, there's been a discussion possible.
Okay, so they're selling the whole thing. On the settlement statement, they would just allocate the personal property and then the investment property. The investment portion could go into another property, but their primary, they would have, they could take code 121 or pay taxes basically.
Yeah.
Because personal property, 2017, they took that out of the code.
Okay. So
does that make sense? So you could, the main house.
The primary house would be 80% they might pay taxes on.
Right.
Little area to the back.
Right. They could do that. Mm-hmm.
Could get that phrase.
You could, but we don't ask for that stuff.
Property's tax value, take percentage tax value.
I had a question about the equal to or greater than, with the example you gave, some of the properties were less than, but is it the cumulative, like if you exchange for multiple properties, say it's $1 million property, you said maybe one was 100,000, one was 50,000, but as long as it equals $1 million or more, or does the property, it's one property staying the same?
Oh, great question. So I think you're asking basically they're selling one property and they say they're buying 3 properties. Like how does the value work for each, all 3?
If they all have to be $1 million or just the total amount exchanged?
Just the total amount exchanged has to be, so whatever they sold for is what they need to put in. Say they're buying 50 properties, that same value, the $1 million needs to go into
so they
different
properties that are less than, but they have to buy more. They wouldn't be able to buy
right.
Property for
that's why it gets, and for realtors, I feel like I get a lot of questions that are like the exact amount, taxpayers, y'all are thinking of the, all the like settlement statement costs, the taxes, the commissions, the attorney fees, all the things. And so at the end, all of that stuff comes out and that's what they actually need to reinvest. But we always say to look at the sales price of what you sold for, because you're going to have all those costs on the next property. So like I talked to a realtor recently and she was like, so I need to buy for more than I'm selling. I'm like, no, because you're going to have those costs because she was basically wanting to go from like 230 to 250. I'm like, you could do that, and you might have to bring a little out of pocket. You'd rather pay a little bit out of pocket than not use all your cash, in my opinion. It kind of just depends on portfolios. But was that kind of your question?
Sorry.
No, it's okay. I just wanted to make sure I answered it. So you go ahead. No, go ahead.
On the reverse, if you were finished with that one, what's the typical way that the property is purchased up front? Because obviously there's not something in holding, buying. the property.
Right. So you'd either have to use third-party lending, cash out of your pocket, or a bank. We are not funding that. So on paper, it looks like
Basically
ABC
buy the
LLC.
property, but then the funds from the sale.
And then the funds from the sale can go, however, if there was a note or a loan, or if they borrowed it, they had it under the red, it goes back to however they want us to pay whoever, that's how we can do it.
And that sell date would start the clock.
Yes. The sale date, not the contract date. But I'm happy to get on any calls, come to any contract signings, do whatever I can be to be a resource for you all. Here is my contact information, but I want to help you all look good. I always say my little selling point for brokers and realtors, you can get two deals within 180 days, which everyone loves 2 deals pretty fast, or 3 deals within 180 days, but guaranteed at least 2. And if you're helping your client save taxes, I'm sure they're going to call you again. So great resource for your clients to know that they can defer capital gains taxes. And I'm happy to, I say I answer questions all day long for free. I do. So call me with any type of questions, no questions dumb. Some questions I'm like, can you? You could, but it's sneaky. And I'm always like, call your CPA, call your attorney. At the end of the day, the CPA is signing off on the taxes, not us. So we like to be a team player and have all the types of resources involved. I'm trying to think if I thought it missed anything. Does anyone have any questions? No?
Million, but.
A million?
Yeah, talk about it later.
Talk about it later. Well, thank you all so much for having me and braving the wind and cold and snow and whatever else is coming.
Don't jinx us.
Don't jinx us. You know what, snow? I know. I kind of ready for the warm. Yes. And I have little goodie bags back there with my contact information. Take a Chick-fil-A sandwich to go. And I'll stick around and if y'all have any other questions. Thank you.